Hi guys, and welcome back to CashBright, your guide to investing in an ever-increasingly uncertain financial world. So NIO has announced that it will be initiating a secondary offering of stock from the end of August 2020. Now this secondary offering is in the form of 75 million new American depository shares. The company intends to raise additional funds for buying back share capital in NIO China, and for general developmental purposes such as R&D. American depository shares simply refers to shares of a non-US company, that is NIO, which are issued in dollars and made available on a US stock exchange. The secondary offering will provide the company with over $1.4 billion, and this could rise further, depending on whether underwriters exercise their 30-day option to purchase another 1.25 million shares. Now, this of course will have the effect of diluting the stock, simply meaning that with more outstanding shares, the relative value of existing shares will be lower. Not a welcome piece of news if you already own the stock. However, this might actually turn out to be good news for investors. Now I know that sounds totally counterintuitive and backwards, but hear me out on this. Whilst of course short-term investors will not benefit from this at all, longer-term investors, even those that already hold shares, still might. The secondary offering and share dilution will naturally cause volatility in the share price from the end of August and into September, and the stock price is likely to trend downwards for a time. Now if you're looking for an upwardly mobile growth stock, this price drop could be a good time to buy. If you already own the stock, this could also be a good time to purchase additional stock in the company. Why is that? Well, if you don't know, NIO was in quite some financial difficulty at the start of the year, and was even bailed out by the Chinese government in exchange for giving up a sizable portion of its equity. The company was not in great shape, and the onset of the pandemic certainly didn't help either. But despite being loss-making, the company's performance has been fairly steady, and the stock price has been caught up in the electric vehicle / Tesla bull run, shooting up around 350% since the start of the year. Now this surge in its stock price gives the company the opportunity to raise much needed funds to buy back some of the equity it lost in the Chinese government bailout, and to increase its revenue flow going forward. This should move the company closer to being profitable, which for stockholders should mean further surges in NIO stock price in the future. This is also helped by the fact that many analysts are projecting the stock price to keep going up given its recent second quarter financial performance. So if we can take a step back and look at the full implications of this secondary share offering, we can see that the benefits ought to outweigh any short-term costs caused by the dilution. I also believe that NIO stock is only really worth buying for its growth potential. I was personally hesitant to do so given the company's recent financial difficulties, as well as of course the uncertain future facing its loss-making operations in the context of a pandemic. But I think the cash boost represented by this offering makes the stock much more investable. Don't get me wrong though, EV stocks in general do carry a certain level of risk, as they involve new technology yet to be adopted by the mass market. But when you look at the picture as a whole, I do believe it's a risk worth taking. Thanks for watching. If you found this video to be helpful, please leave a like, and don't forget to hit the subscribe button. And until the next time, stay sharp, stay hungry, and stay cash bright.